The will. Dying without a will is known as dying intestate. If you die intestate, your bank accounts will be frozen until all payments and legal stuff is dealt with. Your dependents may be left without anything to support them. Your money, estate will be split amongst relatives in proportion to government rules. Non-blood relatives, adopted kids not included. The legal rules are very complicated. A common law marriage is not recognized the same way as legal marriage. Money could go to ex-spouse instead of your present partner. Your money does not go directly to your spouse, just part of it. The rest could go to your brothers or sisters you have not spoke to in 20 years. A will can stop relatives fighting each other when you die. The person you hate most might get the most without one. Draw up a list of your assets. Decide who you will leave each one to, and in what proportion. Keep records of your assets, including information about children and your wishes, how you want your funeral to take place, etc. Estate includes life insurance paid out. Choose an executor, a neutral person who handles the estate, money, property, and funeral of the dead person. Executor can legally be someone receiving something from the will. Make sure they are bright enough to deal with the paperwork they will be given. Probate or grant is written authority to settle your estate. The executor normally gets it. The probate is shown to the probate registry with the will, death certificate, and list of assets. Executor fills out forms and proves information is correct. Inheritance tax is paid on an estate value above a government threshold at 40% tax. You have got to have a lot of money before it affects most people. To save tax money, make beneficiary owner of insurance policy. But remember, as owner they could cash it in. Gifts to spouse. Annual gifts up to $3,000 a year. Small gifts to your child up to $5,000. Gifts to charities. Financial advisor. Financial advisors handle debt, life insurance, pension plans, saving plans, stocks and bonds. Ask at bank, building society, accountant, stockbroker. Tied agent represents a company. Will sell what is best for their company, not necessarily what is best for you. Multi-tied agent represents a group of companies. Independent financial advisors, IFA, has no connection with companies they recommend. They spend their time studying companies to give the best advice to clients. They can be expensive. You pay by hours worked or a fixed cost or commission plus a fee. You have to pay their fees whether you accept their advice or not. They could go for the highest commission so they get the best commission themselves. Whether your investment goes up or down, they rely on word of mouth for new clients. Stockbrokers buy and sell bonds, stocks, and shares for a fee. Ask yourself, after tax, transaction fees and other expenses, is it such a good investment? What will you really earn? If you buy and sell regularly, these extras eat away at your profits. Investments. Investments can go down as well as up. In general, the higher the interest paid out, the higher the risk of losing your investment. ISA, Individual Savings Account, allows you to invest up to a government set limit in pounds per year over a set period, free of tax. If you take the money out, it does not reduce the amount you have put into it for tax purposes. Every deposit you make is classed as a step towards your limit. If you take money out before the end of the agreed term, you will have to pay a tax on it. Government national savings investments are guaranteed to pay out as long as the country is running. You can only lose out if the country is taken over in a war or something. Government fixed interest certificates are untaxed, but there is a time limit before you can get your money and interest back. Index-linked certificates are the same, but linked to national index. Income bonds are the same, but they are taxed. Capital bonds timed and taxed. Government bonds are issued to supplement tax when money is short. If money is short, the economy must be in a mess. These bonds are known as gilts. You buy your bonds and the interest earned is paid each year. Then at the end of the agreed time limit, you get your money invested, the capital back. The interest rate is shown on the bond. It is regular interest. Foreign governments and local authorities issue bonds. Companies also issue bonds, but they have a bigger chance of going out of business. Shares are known as equities. Companies issue shares, which people buy. This money raised goes to finance the company. As a reward for investing in the company, money is sent out yearly as a dividend. The company decides how much money to issue and divides it between its shareholders in proportion to the shares the shareholders have. People can also make or lose money on the stock market. The shareholder is allowed to attend the company's annual meeting and vote for the directors of that company. If the company closes, you will lose the value of the shares you hold, but will not be responsible for any debts the company has. Preference shares give a fixed rate dividend. Investors are paid out on their preference shares before ordinary shares. There is no vote, but you have the better chance of receiving money if the company closes down. Cumulative means if the company does not have the money to pay out, it will pay next year, or when it can, the amount owed. There are investment clubs where people pool their money, buy shares and share out the profits. This is a hobby where people study share movement and rules similar to professional companies. With work, skill and luck, some have done well. Practice following shares with imaginary money before you use real money. A bit practice might give you a better chance of success. Your consumer rights. You have the right not to remain silent. Anything you say will be used in evidence against anyone that has provided goods or services that are not good enough. If you give up these rights, you are stuffed. There are laws that protect the consumer. These laws are called statutory rights. Most things are guaranteed for a year. If it goes wrong in that time due to the way it was manufactured or sold, you may be able to get a refund or repairs. They are allowed to repair things before offering you money back. That is why you should keep the receipt handy as proof of purchase. A receipt is not a legality, but it does offer proof. The trader has to protect themselves too. Some people just try to con them. The Goods and Services Act basically says that anything you pay money for must be fit for the purpose intended and of merchantable quality. Learn that phrase. If it is not, then you can't complain. Notice it says services. This could mean anything from the window cleaner who leaves marks on the glass, through your landlord or local council who have not done repairs, to the stripper you hired for the stag or hen night. If the crab paste you bought tastes horrible, take it back to the chemist. If they are not traders, it is a private sale, and it is a case of caveat emptor, buyer beware. The Trading Standards Office can be found through your local county council. If someone sells you something at the door and you had not asked them to come, and it costs more than £35, you have 7 days to cancel. The cooling off period. Even if they asked could they come out on the phone beforehand. If you contact them in reply to an offer, it is regarded as an invitation to treat, and you are the one making the offer. Verbal contracts are not worth the paper they are written on. Take a witness when buying things. As soon as you have checked goods are correct, read the guarantee. Fill out and send off guarantee card. It may need to be stamped by the trader you bought it off. You may be given a time limit to get the guarantee registered. It gives you manufacturer's rights as extras. Consumer Credit Counseling Service.